Just a few months ago, everyone wanted the US dollar and US assets. The Economist even came up with a cool cover. And if the last 10 years were anything to go by, the next 10 would be no different. The US was the exceptional economy, solid growth, low inflation, and interest rates moving in the right direction. But things have flipped and fast. The latest economic data shows a GDP contraction. The US somehow is tearing up the very foundations that made it the world's safe haven. So here's what's changed. Tariffs are back in a big way. The latest round of tariffs, some as high as 145% on Chinese goods, are stoking inflation instead of controlling it. Frictions between the Trump administration and the Federal Reserve are heating up. Trump wants lower rates, but the Fed is stuck between fighting inflation and supporting growth. And foreign investors are overexposed to the US market. Over the last decade, about $18 to $20 trillion flowed into the US from abroad. Foreigners still own about 18 to 20% of US stocks. That's up from 7% in 2000 and 2% in 1960. But they've started to pull back, selling about $63 billion since March 2025 alone. There's a growing consensus that the dollar index DXY could fall further by as much as 10 to 20%, which could push it down to 80 or 90 range. For context, that's a level we haven't seen in years. The dollar just hit a 3-year low against the euro, dropping to 88 cents per euro. So 1 euro now buys $1.14. If you look at the drivers for this sell-off, there are three underlying patterns. The first is the repatriation trade. European investors are pulling money out of the US assets and bringing it back to the Eurozone. The second is the loss of safe haven status. The dollar and treasuries are no longer acting as the ultimate safe haven. Both are dropping as global investors look elsewhere, like the euro or even the Japanese yen. And then is the de-dollarization effort. There's a growing sense that the US dollar's role as the world's reserve currency is under threat, and there is at least some concerted effort to make it that way. If US institutions are seen as less reliable, global capital naturally moves elsewhere. What's more interesting and probably a bit scary for capital deployers is the following bit. As the dollar falls, this time people are also selling treasuries. Normally when there's a crisis, treasuries rally. Not this time. The yield on the 10-year treasury has bounced around from about 4.17% to 4.46% just this month alone. Some people think we could see 10-year yields above 5% or even higher if the exodus from the US assets continues. This is a double whammy, a falling dollar and rising yields. That's just not supposed to happen at the same time. It signals a crisis of confidence in the US as the world's financial backbone. And if the dollar keeps dropping, foreign central banks and investors may keep selling treasuries, which would push yields up even more and make US borrowing more expensive than it is today. The euro is the main beneficiary of the dollar's weakness, at least for now. Some analysts see euro to USD heading towards 1.15 in the near term and possibly 120 in 2026 if this trend continues. But obviously, it's not all sunshine for Europe. There are political and economic risks that could add volatility to the euro. But when there are losers, there are winners as well. With all this uncertainty, gold is shining. Goldman Sachs just raised its year-end 2025 gold price target to $3,700 an ounce, with a potential spike to $3,880 if recession hits. What I keep coming back to is this reserve currency question. This is actually a big one because the US dollar's status as the world's reserve currency is being questioned more seriously than any other time in recent memory. If global trust in US institutions keeps eroding because of erratic policy, trade wars, or political dysfunction, more countries will look for alternatives. That could mean more reserves in euros, gold, or even digital currencies down the road. The Fed could try on its part more quantitative easing, but using QE to fight the fallout from bad tariff policy is just uncharted territory. I think there's a clearer trend emerging. We're witnessing a fundamental shift in global finance. The US dollar no longer feels like the unchallenged king, and that's going to have ripple effects through everything. from the price of your morning coffee to the cost of government borrowing. If you're invested in US assets or just care about where the world is headed, now's the time to pay attention and think about how to hedge your bets. The countries that are absolutely salivating right now are China, India, and other sets of countries in the BRICS bloc. This is a once in a decade or even a lifetime opportunity for them to unseat the dollar as the global currency. Those are just my thoughts. Do you agree? Are we at the start of a new era for global currencies, or is this just a blip? Drop your thoughts below and screenshot some of these charts. This story is far from over. I'll see you on the next one and have a great day.